Hello and welcome to the second episode of our classroom series on options. In our last video, we ended by saying that the dice is visibly loaded in favor of the option buyer, and why would an option seller agree to that? Just to revisit, the option buyer takes limited risk for unlimited reward, whereas the option seller risks a lot for limited gains. On top of that, an option seller pays full margin on positions while the option buyer only has to pay the premium amount. The reason is simple. The option seller wins more number of times, and even if these small wins add up, with discipline he builds a lot of coppers. The option buyer wins big when he does, but consistency is the key. To explain that, let's look at the type of call and put options that we have. They are broadly classified into three categories: at the money, in the money, and out of money. When the strike price and the market price are same, it's called at the money. An option is in the money if in case of calls, the strike price is lower than the market price, and in case of puts, if the strike price is higher than the market price. And it's out of money when a call option strike is higher than the market price and put option price is lower than the market price. Okay, let's simplify further. For a stock trading at 100 rupees, both the 100 call and put are at the money, 95 call is in the money, and 105 call is out of the money. Similarly, 105 put is in the money and 95 put is out of the money. There is an extreme called deep out of money, which means it's very far from the market price. So 120 call and 80 put in this case will be deep out of money options. Finally, what decides at what price do these deals take place on options before expiry? Well, there are two main components: an intrinsic value and a time value. Intrinsic value of an option is what it would be worth if it expired today. And the time value, well, is the difference between the market price and intrinsic value, and is dependent on factors like number of days to go for expiry, events, and market volatility. For example, today when Tata Steel was trading at 1240, the call was available at 38 rupees. The intrinsic value of this call is 0 because if it expires today, the call buyer gets nothing, and hence the entire value of the option is the time value. A 1200 call was trading at 61 rupees, which means that there's an intrinsic value of 40 rupees and the value of 21 rupees is the time value. This time value will be higher in case of volatile market and ahead of events like results and budget, and that's why you see that options get very expensive ahead of results. So getting back to the original point then, in 90% cases, options will come down to intrinsic value or 0, which is why I say that option buyer would end up losing money and option seller would end up making money. But that's the key. It's possible to make money even when you know that option will become worthless ultimately. And the key to that is in exiting the option. And more on that in our next video.